Hi everyone, welcome to this month's Financial Market Update. I'm Piers Bolger, I'm Chief Investment Officer for Viridian Financial Group. Well, this month it's all about the performance of markets over the month of October. Historically, October's been a pretty challenging month for financial markets, and unfortunately 2018 is no different. Our local market's down roughly around about 6.5%, and global markets are down nearly 8 to 9% over the course of the month. What have been the key drivers of this underperformance that we've seen after a period of relatively good stability? From our perspective, there's really sort of four key areas. First and foremost, we've seen interest rate rises, principally from the US Federal Reserve. That's flowed through into bond markets, where bond yields have also moved higher over the course of the last couple of months. We've seen concerns about valuations in equity markets, and are they getting into bubble-like territory? And then finally, and probably most importantly from our perspective, we're seeing concerns about the trade impasse between the US and China not getting any better, with the potential that the US will further impose another $200 billion worth of tariffs on China early into the new month. When we look at the first three factors, we really think that they are part of a normal cycle of investment markets. Fed raising rates, in our view, is appropriate. The US economy remains very strong. We continue to believe that the Fed will increase rates through the back end of 2018 by another 0.25%. We think market valuations are also continue to be relatively sound and stable. Third quarter earnings out of the US, by and large, expectations have been met, and we believe that if you're looking at our local market, again, earnings remain relatively stable. So we don't feel valuations, by any stretch of the imagination, are out of sync of where they should be. And bond markets and bond yields, that's a natural rise that we continue to expect as interest rates move up. And that may cause some rotation between equities and bonds, but in our view that's appropriate given the nature of financial markets. The big unknown and the big challenge that we're seeing, which is causing, in our view, quite a lot of volatility, is clearly how the trade impasse between the US and China will end, and whether there'll be some rectification around that, and what the implications are for that in terms of longer term earnings. As I said, when we think about that in the context of our portfolios, we think it's appropriate and have been reducing some of our risk exposures. But we're doing that in the context of understanding that we still believe that there is opportunity in investing in equities, and we certainly believe they should remain an important part of every client's broad-based portfolio. As always, if you have any concerns or queries, please feel free to talk to your advisor. Thanks, and see you next month. Bye for now.